Hi, everyone. Thank you for joining us today. I'm Marcia Butler, the webinar director at Advice Chaser. We're so glad you're here. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we're thrilled to bring you today's educational presentation. Here are a couple of housekeeping notes for those of you in the audience. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your phone number as well. We'll make sure someone reaches out to you after today's event if that is not able to be addressed during the webinar today. Well, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Since starting his practice about a decade ago with Northwestern Mutual Wealth Management Company, Joshua P. Carter has specialized in working with people in the red zone of retirement to define, build, and enjoy prosperous lives in retirement. Josh's commitment to a planning first mentality gives his clients confidence when developing a plan to turn assets into income. Josh is a graduate of Florida State University with a double major in finance and business management and a minor in Arabic. Josh is a certified financial planner, chartered financial consultant, and retirement income certified professional, holding FINRA Series 7 and 66, 215 life, health, annuity, and long-term care licenses, serving clients in 19 states and every U.S. time zone. Please welcome Josh Carter. Josh, I'll go ahead and turn over the time to you.
I appreciate it. And I appreciate the warning, as always, about jokes not landing. Because sometimes they do, sometimes they don't. So that is much appreciated. I think makes a lot of sense. So, but hi everyone. I'm Josh Carter. I help investors design portfolios to accomplish their specific goals with the utmost confidence. Today, I'm going to show you 5 ways to thrive throughout your investing career. I'll show you how to define your own goals, balance risk and reward, why diversification is your friend, and maintain the stalwart discipline strategy, and also create unstoppable momentum. This all starts first with having a plan and working it. These fundamental core strategies are relied on every day by large investment institutions today still to help them navigate the choppy waters of the market. So what we're going to do is just bring it down and boil it down to our level for you. So, but starting off, the stock market is a complex thing, isn't it? With so many diverging narratives and headlines, as we saw in a year like 2022 last year, it can be hard to make sense of it all. As soon as we reach market euphoria, it always seems that the rug gets pulled out from underneath us. But you know, conventional wisdom that kind of holds up when that tells us what goes up must come down. But even if you understand that market volatility is a normal occurrence, it can be tough to handle when it's your money at stake, and not just something happening far away and in Wall Street land. Part of what we'll go over today is how to come to peace with the fact that the market is and always will be volatile, and how that will actually can be a good thing for you if we do things right. So to start off, we believe that expert guidance is really invaluable when it comes to building your own portfolio, and that asset allocation is the foundation for a diversified investment program. We also believe in the value of investment fundamentals, like basic principles like starting out early, investing regularly, making it a habit, and using these strategies to help reduce the impact of market volatility. So before we get into strategies, I do want to talk a little bit about market declines, because they are the main reason why people shy away from investing, or at least are hesitant to jump 2 feet in. Think back to recent market plunges, like the market going down 32% over 15 days in March of 2020 as the pandemic really started, or pretty much all of last year, between Russia invading Ukraine, between interest rates increasing, inflation, midterm years, all the rest of it. What does your gut tell you when something like that happens? Is it to sell everything and move it to cash? Or is it to pull money out of one investment, maybe put in something that feels safer? Or is your instinct to wait it out and see what happens long term? If you felt a little bit of panic when those things happen, you're certainly not alone. In the midst of market dives, it can feel extremely unnerving. It can feel like the 4 most dangerous words in investing, which is this time it's different. So, thinking about, do I need to make a shift, and how do I make the bleeding stop? But here's the thing, market declines really have to happen. Here's a look at on the chart here at how the markets have performed over time in single year increments. When we're looking at single year returns, the market is positive 3/4 of the time and down, therefore, about 1/4 of the time. That 26% can feel scary when it's your money at stake again, but if we look at results over a longer time period, things start to feel a little different. When looking at a 5-year rolling period, the stock market has been positive 87% of the time. And by the way, none of these numbers that we're looking at right now are including dividends being reinvested, which we'll hit on in more detail later. And while holding stocks for the long term isn't a guarantee, you won't temporarily lose money. That word temporary is very key. But over a 15-year period, stocks have never had a single negative return, which is definitely encouraging, especially for goals like retirement planning, which are usually, for most people, most savers, a decade or 2 out from being needed. So temporary declines, again, that keyword temporary declines are inevitable, but there will always be ways that we can mitigate the effects of this on the portfolio. The first step to a sound investment strategy is to figure out what your goals actually are and define them. What are we actually trying to accomplish with the investments that we have? For some people, it's investments or it's retirement, like I mentioned a moment ago. For others, it's saving for kids' college or grandkids' education. Really, there's as many reasons to invest as there are investors. But we need to tie specific goals to a specific portfolio so that we can really measure our progress towards these goals, which will tell us if things are going well or if things are going poorly. So it will kind of tell us if we've arrived, so to speak. But with this first piece, details. If we just have a blanket goal, I want to buy a vacation home, there isn't much to go off of there financially for a goal with that little bit of detail, which lessens our chance of actually making that goal happen. However, if we add more details, like how much space we need in the floor plan, do we want a 3-2? Do we want to rent it out? What kind of amenities do we want to have? What time frame do we have until we make this purchase? For the purchase, what kind of down payment do we want to have set aside? Are we flexible on that? these types of specifications can help you and your advisor be guided towards the appropriate investment mix. This type of planning puts you closer to this detailed planning, puts you closer to actually accomplishing your goals. Because if you're 100% in stocks, for example, saving for the down payment on a house 2 years from now, and let's say you wanted to buy that house first quarter of 2022, well, all of a sudden you're not feeling good about buying that house anymore because the market has started to fall off a cliff. So having the right mix definitely helps. But very simply, identifying your goals brings them from the future into the present. And knowing where you're headed can carry you through the emotional ups and downs that the challenging markets kind of generally accompany. So this holds true no matter what you're planning for, especially the R word, right? Retirement. Most of us want to retire at some point, but that means different things to different people. Maybe for retirement, you want to move to a different state or even a different country. I've got a client actually that just retired and they're moving to Spain next month. Some people want to focus on family. And I got another client who's just completely dived into volunteering. And then some people just want to travel and spend time doing hobbies and that kind of thing. These are all very different outlooks for retirement. And so the funding and the planning for it needs to match what your specific goals are. So again, we have to be specific with what we use your money for, what we want out of your money, really. The first thing here is making the goal measurable. How much will the dream retirement cost? For example, maybe you analyze your retirement plan and decide you need $1.5 million to cover it. So the second thing, that time frame is, that $1.5 million, that will mean one thing if we want to retire at 65, we'll kind of need to hustle if we need to get that goal by 55, right? And then there's the longevity wild card. How long do we, is God going to give us on this green earth, right? The next piece is the resources. So taking into account all the different resources that we have for retirement, for example, things like a 401k, how much you're contributing versus how much of a match you're getting from your employer, Roth IRAs, maybe a pension if you're lucky enough to have one, Social Security. And then lastly, once we figure out what we have and the resources are, really kind of identifying where the specific steps are that we need to tweak the plan to make sure that we're on track. So for example, maybe we need to increase the 401k funding to 15% of salary and at retirement peel off a certain amount and put it into an income annuity or something because we don't trust Social Security. Whatever it is, in using retirement as an example here, but most people have multiple goals that they want to be working towards. So, and it's also common for people's goals to change over time as life evolves because it has a way of doing that. Life throws us curveballs. And so we need to kind of pivot the portfolio either because of what's going on in the market or what's going on with you personally. And that's why it's important to revisit your plan at least annually, especially when a major life event happens, so that your plan stays relevant to your life. The last thing we want to do is just kind of let things rip off into the future without having a handle on that. So again, there's no getting around the fact that the market is risky. And I'll explain why this is in air quotes in a minute, but investing definitely is a no pain, no gain endeavor. Which is why the second step to investing successfully is understanding risk. This means protecting yourself against risks when you can, and when risk is inevitable, which it always is with investing, and knowing how much volatility you're willing to take on, how much you can stomach. So the first part might seem counterintuitive or maybe just a surprise, but the first part of understanding risk is planning for the unknown. Things like car accidents and house fires and floods, disabilities, or passing away prematurely will throw a huge wrench into you and your family's financial plans. no matter how strong your investment strategy is, if you have to stop and use those funds that were meant for one goal for a different need, that's going to affect the ability that you have to reach the original intended goal. So for example, if you were injured and didn't have health insurance or enough money in an emergency fund, you might have to pull from your 401k to pay for an unexpected hospital bill or whatever. Once you've recovered, you have to build those funds back up, which can be very hard to do, especially if there isn't margin within the budget to build things back up, not to mention the loss of where the market might have taken things otherwise. And if you miss work, because of the injury, you might also be missing out on income to rely on for just regular expenses. So protecting yourself and your income is a must for most people in their 20s, 30s, even their early 40s. A lot of times their future income is still their largest asset. People if they're good savers in their 40s, 50s, especially their 60s, most amount of income they ever make is behind you, not in front of you anymore. And hopefully we would have turned some of that into financial assets with an investment portfolio that we've talked about here. But all that to say, getting insurance to cover major risks and building up a solid emergency fund will help you get past any, again, curveballs that life throws at you or any speed bumps that we want that get in the way. So, but once that strong moat, you can't really see my hands, but once that strong moat of risk management in place, building the castle of our wealth with the investment strategy within the context of an overall financial plan won't be derailed if unexpected events occur that dampers everything that we've been working towards. So, Marcia, are there any questions that have come in so far out of curiosity? I want to pause for a second.
Yeah, there was a question here about what if you are dealing with a disability in the family and the disability is of a child. Obviously, you're using those emergency funds as that child is growing up. You talk a little bit about how it's different for families that are maybe not have that kind of that time to build up an emergency or time to build up those kind of things before an emergency happens.
Yeah, that will definitely make things a little bit more difficult. That's where coming back to the basics of what does cash flow look like will really help us get back to ground zero, so to speak. So, I think that re-looking at where cash flow is and what other kind of resources are available. We've helped a number of families who have special needs kids. And there are some state benefits that a lot of people just don't know about. And so incorporating that into the cash flow for the child's benefit can help get at least that part of the financial life under wraps so that we can look at building back up the long-term assets with in the investment strategy. One thing that definitely helps with that is a special needs trust. But again, that varies from state to state. So I'm fairly in tune with the Florida laws for that, but you'll want to definitely talk to a state-specific attorney with some of those more niche questions. But
yeah, that's interesting. So starting with cash flow, you said is looking at what you have, what's coming in, what's going out is the most important first place to start for you. Yeah,
and a lot of people things tend to get away from us. In other words, everything's on a subscription basis now. You plug into Netflix and Hulu and cable and phone bill and da. All of a sudden we're spending $3,000 a month, and on paper we're only spending a lot less than that on other miscellaneous things. So I think looking at the budget is definitely the first place to start. That's going to create some margin that we can help address things that are popping up in life that we didn't expect. And kind of get a better game plan in the future in case another thing pops up. Because again, life has a way of doing that. So
we did have one other question. And I think this is probably a more lengthy answer, or maybe we're going to address it as we go on. But it said, is there a formula to calculate about how much you need to retire?
So that we'll get into that a little bit more detail. That will in large part depend on somebody's risk tolerance, which is what we're actually talking about here. So that's a pretty good segue, actually.
Yep.
I'm going to keep that in the back of my mind, though, because the 4% rule that a lot of people have gone off of for a very long time is really debunked. I mean, it doesn't fit for everybody because of longevity. People are living longer, but so yeah, let's talk about risk a little bit, because if somebody has a lot of risk tolerance and they can be 100% in stocks and they don't like bonds because historically they haven't done as well, that person's withdrawal rate is going to probably be higher, but they need to have a contingency plan in case the market goes down. We never want to sell from a position of weakness. We always want to sell from a position of strength in retirement. So now somebody that can't stomach volatility and any of the sky is falling narratives of the day are going to make them sweat in the palms a little bit. We're going to need to be more conservative, but that's going to lessen our expected return. That's going to draw down on our long-term distribution percentage. So, but anytime you invest, there's risk involved. There's no sure bet, but everyone's risk tolerance is different, and that's fine. There's no real right or wrong answer to risk tolerance, but we use an investor profile that we worked with an industrial psychologist to really measure investors' understanding of risk and how they feel about it. Looking at things like how long you'll be invested for, the top bullet point here before you need the money. If we have a really long time horizon, we can have more in stocks, from a risk capacity standpoint. If we have a really short time horizon, we probably need to lock in some returns and take some risk off the table, take some chips off the table, so to speak. When you're ready to start using the funds, how long are we going to be withdrawing from the funds for? If it's a house down payment, it's just one-time lump sum. If it's retirement, it's upwards of 30, 35 years sometimes. So how much money do we already have in safe and stable assets like permanent insurance, pensions, fixed income assets? Those more stable assets, we need to take that into consideration as part of the overall strategy. And then figuring out, liquidity, the budget that we talked about, income stability. I've got a client, his base is like $100,000, but then his bonus is around $860,000, and that happens once a year. So that income stability, that liquidity, it's very different from somebody who has just a $120,000 base salary and that's it. That's going to be a different type of planning. But all of these things factor into how much risk we can handle and how much risk we can objectively take. The former is what I call risk tolerance, again, how much you can stomach. And then risk propensity is how much you can objectively take if we just took emotions completely out of the equation. So understanding both of these will really give you more confidence going into investing in the market. So that blended in really well. So, but it's also good to recognize what returns look like when we kind of zoom out and look at things from a 30,000-foot view. Look at how volatile things actually are from a long-term time perspective. That's because over a long term, periods of high returns tend to offset periods of low returns. So this chart here looks at the S&P 500, which is the 500 largest publicly traded companies in America, what most people call the market. This is how those have performed since 1950. If you look at these decades separately, there's lots of dips in here. We've got one here, kind of the later half of the 50s. We've got one here, mid-60s, definitely a deeper one here, mid-70s. We've got the 80s with Black Monday there, that big spike down. The 90s were just fantastic. That's just all there is to it. And then followed by a horrible decade, the lost decade, as we call it, because we had the dot-com bubble bursting in the beginning. and we just ran it back and said, let's just crash everything again with the subprime mortgage crisis in 2007, 2008, 2009. And then we had Facebook and Amazon and Google all coming of age here during the 2010s. So, but during these 70 years, we only had one negative decade return, and that was the lost decade, the knots, as we call it. And that again followed by a very positive decade during the 2010s. So the trend is for the market to increase because human ingenuity is always creating better and better products and systems and services. And we can see that even though the market drops at times, staying invested over the long term helps reduce the risk in the long term. So
yeah, there
let's
was
see.
another question in the comment. Maybe we can talk about it with this graph. So what's considered like a really long time for investing? Is 10 years considered long term, 15 years? What are you talking about when you say an investor has, if they have a long term for investing, they can have more risk?
Yeah, absolutely. So I would say that somebody that is an aggressive portfolio owner, that starts at 70-30. So 70% in stocks, 30% in bonds. That generally would make sense if we're looking at about a decade time horizon. If we're looking at something shorter than that, then we definitely want to be more balanced, maybe 50-50 or even 40-60, 40% stocks, 60% bonds if we're looking at a 5-year time horizon, something like that. Now, again, there's always risk in the portfolios. Generally, if stocks are going up, bonds are just kind of chugging along. If stocks are going down, bonds usually take off. I say generally. 2022, that was not the case. That was the 4th time in U.S. market history when stocks and bonds fell in lockstep. And so that generally only happens during an initial inflation spike. So check, we had that last year. So last year, stocks, growth stocks were down about 28%. Value stocks were down about 5 to 9%. The overall market, the S&P 500, we're looking at here, was down about 18% last year. Bonds were also down about 15%, depending on how risky the crediting rating was on those. So, having a meaningful amount of cash can definitely help with, depending on what the goal is. For most of my clients in retirement, we generally have what's called a time-weighted asset allocation approach, where we have different portfolios set aside for different time periods. So first 2 years of retirement, we have cash, because the only thing that can screw up a short-term goal is if the market goes down, right? Now, long-term, for 15 plus years out, we're like 90% stocks. And the reason being is because we're not really concerned about down markets between now and 15 years out. What we're concerned about long-term is fighting inflation. And if 2022 showed us anything, that's that inflation is in fact still a real thing. And so, I mean, we paid $9 for a dozen and a half of eggs the other day. That's crazy. But it would help if my wife didn't buy the organic pasture raised and all the rest of it. But for those long-term dollars, the risk is not a down market. We know that's going to happen. The risk long-term is fighting inflation. So it really just depends on the specific goal and the specific investor. I know that sounds like a cop-out, but that really is the case, because some people can stomach markets going up and down, and then some goals can stomach the market going up and down. Mm-hmm. If we definitely need money in 5 years for a kid's education, we don't want little Johnny, have to go to community college for a year because, the 529 dropped off a cliff the year that they enrolled in school, right? So it depends on how urgent the money is needed, and then what other, do we have any kind of flexibility with the goal?
Right.
So that leads a little bit actually into the next piece.
Before we move on, just for clarification, I got another comment. Does that mean that, say, 5 years into your 10-year plan, you switch from, say, 70-30 to 50-50, if that's where you are in your life?
Not exactly like for a retirement goal. For my clients that are at retirement, again, we have 2 years of cash set aside that we need from investments. So excluding mailbox money, as I call it, like Social Security, rental income, annuity income, that kind of thing. That's all guaranteed. That's a good floor of income. Anything that we need on top of that, we want 2 years at least of that cash on hand. Then the next tranche that we have is 3 to 5 years. We have a certain asset mix, usually around 40% in stocks, 60% in bonds for that time period. And then the next time period out is going to be your 7 to 14-year money. That's generally 70-30, 70% stocks, 30% bonds. And then the last one, 15-year plus, that is that's where our 90-10 portfolio comes in. How we do things for retirement is that as the cash gets spent down, that next bucket fills up the immediate cash needs. And then the 70-30, that's a little bit further out, fills out that 3 to 6 year need, 3 to 7 year need. And then the 90-10 refills the 70-31. I know that's hard because I don't have a visual for that that example, but retirement is a very different animal compared to the other types of investing, because you're living off of assets at that point. It's not just funding one specific goal. And that really does lead into, I'm not just saying that does lead us into the next topic here, which is diversification. So,
and we got a thank you from the commenter. So apparently
absolutely.
that was exactly what they wanted to have clarified. So thank you so much.
Because if we have, there are 9 different asset classes we can possibly invest in the investing universe. And if we have all 9 of those represented in the portfolio, well-diversified portfolio, takes risk off the table, because if for a year like 2022, for example, everything was down, all 3 of the US markets, large, mid, and small, international, emerging, and developed, real estate, fixed income, the only thing that was up was cash because inflation was high, and then commodities. And for my clients that are in retirement last year, we sold our retirement, our commodities holdings, and we locked in a 22% gain in the first week of August. That's what we use to generate income. If we're not properly diversified, then we could run into a situation where everything's down. We have to sell something for a loss. I never want my clients to sell anything for a loss. Between the cash and the portfolio, we're going to have something to sell for a gain, which again is why I've kind of put the cart before the horse here. I kind of went a little bit too detailed there, but let's take it back high level.
Yeah, no, that's okay. I mean, giving an example is really good, and then let's see how that example is done by the general principles here.
Exactly, and we're gonna go into that favorite chart that you love that you've never had explained properly in a minute.
Okay, so thank you. Yeah, we talked about that before the webinar. Josh, you better explain this chart because I've seen it before and I don't know what it means.
Yeah, I'm on it. All right. So between different asset classes and investment vehicles, they're all available, by the way, from hundreds of different financial providers. Investors today have a huge number of options to sift through. Where you invest your money depends on, again, a lot of factors like we've already talked about. What are we specifically trying to achieve, risk tolerance, how long we need to be invested for, what are the options that are even available to you for specific goals. Diversification is basically just splitting up your investments into different kinds of assets so that you're not putting all of your eggs in one basket. Finding the right combination of different uncorrelated investments to give you a smoother investment experience. So asset allocation is exactly what it sounds like. It's splitting up or allocating your funds to different asset classes to create a diversified portfolio. We want to own each of these 9 different asset classes in a strategic proportion. It doesn't have to be complicated in order to work, but each asset category has something unique to contribute to the overall long-term investment plan. Equities, like stocks, typically offer greater long-term growth potential, but they also have a higher level of short-term risk, as we've talked about with sending Johnny off to school or buying the house. Fixed income securities like bonds have other benefits and detractors. Bonds are focused on income generation, but don't really have a lot of capital appreciation. Cash alternatives like money market accounts provide liquidity and preservation of principal compared to other asset classes generally, which is why they're good for short-term goals, because we can really count that the stability is there. Having a broad asset class minimizes risk further. For example, the US stock market is composed of small cap, large cap, and mid cap companies. That's not shown on here. Cap is just capitalization. That's the size of the company. Each of which can be further subdivided into growth companies, which are not paying a dividend generally, or value companies, which are generally paying a dividend and are cash heavy. International holdings subdivide into international developed and international emerging markets. Bonds and cash, again, subdivide into different investment gradations, how risky the underlying issuer is, maturities, sector, even tax status, like with the municipal bonds. Now, one question here. So have you ever noticed that when the market goes through a rough patch, there are always people that you talk to when things are going sideways, when things are going down and they're like, man, I lost a lot of money. And there's other people who basically sail through and barely get touched by the market losses. Why is that? It's not just because some investors are lucky and they picked the right thing, or that there's some secret that they have that gave them an edge. Those investors who do better usually understand diversification and asset allocation more. Different asset classes have different benefits and drawbacks, and they tend to react to macroeconomic activity differently and market trends. So combining them can help provide investors with a balance between, again, expected risk and return. The goal is not to own too much of any one thing that will generally make sure that, I'll put it this way, we generally don't want to own too much of any one thing that will make a killing on it, but also not too much of any one thing that will get killed by it, right? Sometimes stocks returns are down when bonds are up and vice versa, like we've talked about before. But when combined, they offset each other typically when investment or when market movements happen. The asset allocation models shown here represent kind of different combinations of stocks and bonds in a well-diversified portfolio. Even though bonds are considered less risky than stocks, notice that even the most conservative portfolios still have a portion of stocks allocated here. Again, this is—
You meant a portion of bonds.
Say again?
Oh, I think you said stocks. I think you meant to say a portion of bonds.
No, so even conservative portfolios have a sliver of
Oh,
stocks.
okay. I'm sorry. I was thinking about the other thing. Thanks for clarifying it.
Yeah, absolutely. So if this is kind of the front end of a goal's closer, this is generally what is going to make more sense. If we have the stomach to handle volatility, having more equities is going to give us a higher expected return, but understanding that's going to create more risk. And really, risk in the context of a diversified portfolio really just means how much the portfolio is going to go up and down, how wide those swings are. That's really what risk means. But that is to say that past performance is no guarantee of future results. You'll hear that a lot of times meeting with financial advisors. But finding the appropriate mix for your specific goal and risk tolerance, that's really required to having a successful experience. So this lovely thing here on the graph is what I call the quilt. So there's a lot of clear advantages to being diversified and having a diversified asset allocation. But many people's portfolio that I find, it's just a hodgepodge of investments based on, hot tips. You you're scrolling through Facebook, stocks to own in 2023, or, maybe even last year's top performing stocks. If there was one asset class that did it all and led the market every year, buddy, I'd be at the top. I'd have that as the number one holding for everybody. But that doesn't always happen. That's not generally what happens. So the market is always changing. And to make a consistent prediction of what's going to be the best performing class or the worst one is just impossible. Even Warren Buffett says that basically, if you know somebody that can do it, let me know, because even he can't do it. This again is what I call the quilt. These are those 9 different asset classes going from the best to the worst for each of these years, this 15-year time horizon. And what you'll notice is that there's really no clear pattern. That's kind of the point. We've got the winners at the top going again down to the losers at the bottom for each year. We've got a couple that have been in there before, international emerging, real estate, that kind of thing. But the only one that's really consistent is this white box. This is that diversified portfolio. That's generally across the middle. We're not getting international emerging here, 78% in 2009. We're not getting those types of returns. But we're also not getting international emerging the year before, which is negative 53%, right? What does this do over the long term? By the way, this white box here is a 60-40 portfolio, 60% in equities, 40% in fixed income. That would put us in a balanced portfolio. That portfolio over this 15-year time frame, the returns, the compounded returns, are in the middle of the pack here. But through diversification, our risk is disproportionately brought down to the bottom 3. That creates a more consistent investment experience. Again, if the market's flying high, we're not going to get all of those, huge returns. But conversely, when it is going down, and that will happen, because the market has to correct itself every, statistically 1 out of every 5 years, we're also not going to experience that full downturn. This helps smooth out what we call our upside downside capture. The amount of the upside that we experience and the amount of the downside that we experience. A lot of times we find clients' portfolios have an inverted upside downside capture, meaning that if the market goes up 10%, we're going to experience 6% of that upswing. But the market goes down 10%, we're going to experience 7% of that downswing. We always want our expected upswing to be higher than our expected downswing. And then we can do that by owning multiple asset classes. So does that make sense?
Yeah, I've never had it explained, so I appreciate that. And it's interesting. So it would be different for every single year. Those squares are going to be different.
Yep. Yeah, exactly. And if we added in 2022 here, real estate was at the bottom. We had really everything was negative except for cash and commodities. So it was one of those years where, again, for clients in retirement, we got to have all 9 asset classes represented, because that will virtually, if you look at this time period here, it's 15 years, we've got 2008 represented. We've got 2018 when the market erased the returns from the beginning 48 weeks of the year. We've got 2020 in there with the start of the coronavirus. Even though we have all those ups and downs and storylines and everything else, there's always something positive that we can sell for a gain, right? But we can only do that if we own everything. So, cool. All right. So, moving along. So next step is really can be the hardest for some people, but once this habit is established, it makes the rest of your financial life so much easier. That's discipline. So I alluded earlier to timing the market. I may or may not have, but the idea that jumping in and out of the market to try and time when the market's going to go up or preempt the market going down, that might seem like a great strategy. But really, you have to be right twice. You have to be right when you exit and then when you re-enter. But it's not surprising that people try and make this emotional choice. That's really what it is. It's not really taking math into it or anything like that, and jumping in and out of the market, hoping for a better return. No one wants to lose money, especially in the short term. But let's take a look at the effects of market timing on a portfolio. This chart really shows if we were invested in in this 20-year time frame that we're looking at for all 20 years, didn't take anything out, didn't add anything to it, we would have experienced about 9.5% during, if we experienced all, I think it's like 4,000 trading days or something like that during this 20-year time frame. Not bad, right? 9.5%. That dog will hunt. But we try and time the market, buying in and selling out at different times when the market's volatile. Let's say we end up missing the 10 best trading days out of those 20 years. That will drop the return basically in half to 5.3%, right? Now, if we miss the 40 best days or more, then we're actually losing money on a gross basis. If we miss the best 20 days, we're losing money to inflation because we're not even keeping pace with inflation at that point, right? 2.6%. So, and since large ups and down swings are generally kind of clustered together, we saw that the first 2 months of this year. By trying to avoid market dips, you can easily miss out on great days also. So, and again, that can have a huge impact on your portfolio long term that we really can't afford to miss out on. If we miss those crucial trading days, again, we saw the impact of missing the 10 best days out of 20 years. That cuts our investments in half. That's going to put a damper on our long-term returns that we need to make the plan work. And again, we want to work the plan and have a plan and work the plan. So when you start to see the market shifting and getting nervous about your investments, it takes discipline, and sometimes a lot of discipline, to resist the temptation to try and avoid those bad times. It takes discipline, again, to sit back, trust that over time your plan is diversified enough, if it is diversified enough, that it will work and it will do what it's designed to do for you. So there's one famous stat out there. I think it was the first 20 years of this century. The S&P 500 average, I think, around 10% a year on the arithmetic average. But the average investor investing in the S&P 500, the market, did 4%. And why is that? That's because of what I call behavioral mismanagement. Buying in when markets are high and things are flying high because everybody's telling you can't lose money because everything's going up, like, before the dot-com bubble bursting, but then selling and locking in losses when the market does go down. We want to buy low and sell high, right? The stock market is really the most efficient vehicle to transfer money from the inpatient to the patient. Is really the best way to think about it. And I didn't. That wasn't me that said that. That was Warren Buffett. Everything in all the different phrases are stolen from somebody else. And here's another phrase, right? Einstein once said that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it, right? Compounding is just when your assets earnings are reinvested in the portfolio, and you start earning interest on interest. And that makes a huge difference over time. This graph, I love this one. It really shows why, well, I'll get into why. This graph shows how much you need to invest to get to $1 million at age 65. We're just assuming a 7% rate of return here and compounding that annually. And we're going to exclude taxes and transaction costs for the time being and that kind of thing. But if we look at the 25-year-old here, the first column, that person will need to save $381 a month to get to $1 million at age 65. That's a total investment of $182,000. We fast forward 10 years and say, well, I'll get to that later, right? And start at age 35. Well, now that person needs to double, more than double what they're saving on a monthly basis to $820 a month. That's a total savings between 35 and 65 of almost 300 grand. Right now, we switch this out to somebody that's 45. Now they got to start saving $1,900 a month to get to that exact same goal. And if we wait till age 55, only 10 years to invest, we need to save a whopping $5,778, or a total of almost 700 grand, right? Why is such a big difference? It's because starting earlier allows the interest to compound over time, right? The more time you give compounding to work its magic, the bigger the difference, right? Because remember, something sooner is better than larger later, right? So this leads me to the next piece of the puzzle. This is letting your plan build momentum. So let me ask you a question. I don't know if anybody can see it on the map or my screen right here, these little things in the corner. Let me ask you something here. So how many of you work out, right? These little things in the corner here, these are actually fencing blades. I was a 3-time junior Olympic fencer. So I know it's not always fun to work out. But here's what I've found. As much as I hated suiting up and my beehive mask was on the ground over there, as much as I hated suiting up some days and getting out there, I always felt better when I did it after the fact, right? And the more I exercise, the more energy I seem to have, and the more energy I have, the more likely I am to keep exercising, right? Reinvesting your investment earnings, which is crucial to the compounding effect we just talked about, really creates a similar type of momentum. That's because when you allow your dividends to compound over time, your investment earnings are building more investment earnings. Income producing investments are key to this approach. They can keep your investment plan on track even during market declines. Why? Historically, many companies have kept paying dividends at the same or increasing rate no matter what the market is doing. It's a very bad sign if a company has to cut their dividends. And so hell or high water, they want to pay that same dividend at least, preferably increase it over time. Bonds and money market funds can also provide a steady stream of interest payments, which can also help cushion the portfolio during market volatility. In a year like 2023, to bring that to present tense, we believe that a mild recession is very likely to occur. And these income producing investments are much more resilient because they are cash flow producers, cash flow heavy. So that's where tweaking, what we call the tilting inside of a portfolio can really, the growth versus the value portions, that's really where that style box tilting can really help, what we call tactically. That's kind of in the short term in the present day. And it can really help a portfolio weather storms. So reinvesting your income, again, key to boosting your returns. Here's a hypothetical growth of $1,000 invested in the stock market and the bond market separately over a 20-year period, with and without reinvestment. Reinvesting, again, allows you to capitalize on compounding, which means you earn, again, income on the principal investment in addition to the reinvested dividends and coupon payments. So if you compare stocks with reinvestments to stocks without reinvestments, the $1,000 growth, that's a 2% annual return differential. With bonds, it's actually 2.6% because they're more dividend heavy or income heavy. So whether it's stocks or bonds, and investing in some kind of income producing vehicle can help, again, maximize your growth, your portfolio's growth. Again, just to clarify this, this dark navy line right there, that is stocks without dividends reinvested. So assuming you just took the dividends in cash and went to Starbucks or bought something on Amazon with it, this is letting the dividends reinvest. So when a company pays a dividend and you reinvest it, you're taking that dividend and buying more shares of that company. And those additional shares are going to pay dividends in the future when the company pays a dividend next year, right? Same idea with the bonds here. Again, just taking the income or taking the income out. Bonds, again, don't earn a whole lot over time on their own. Their value really is the income being reinvested into the portfolio. So keeping in mind, this is talking about from what's called a total return perspective, which means that capital appreciation, the income and interest of the income are all taken into account with the return here. One thing to think about too is that this is really why we want to have stocks and bonds in a portfolio. If we had this started at 2001, right in the middle of the dot-com bubble bursting. If we wanted to buy a car or a house or whatever in 2002, right where my cursor is, right, we're not feeling good about buying that car with the stock situation here, right? But the bonds, not too bad. Take this out long term. It's much better to be an owner of a company, which is what stocks are, than being a debt holder against a company, which is what bonds are over the long term. So let's see here. So yeah, that's basically these 5 investment basics will really help you stay on track and have a disciplined approach during market ups and downs. I know we've covered a lot today, so just taking a look at these last 5, these steps here again. Again, set specific goals, align the right amount of risk with those goals, diversify with your asset allocation within that portfolio, stick to a plan and work the plan, and then let the growth compound. So there's a lot of information and noise out there when it comes to the markets, right? Financial journalism really just makes money off of fear. So even when you're comfortable with the basics of investing, it takes time to make sense of it all, and it's difficult to be sure you're making the right choices to be successful. That's why it's helpful to work with a financial professional, someone whose job it is to know all of these concepts and how they work together. You want someone who can help you wade through all the information out there and create an objective and sound investment program to grow and manage your wealth, incorporating within the context of a strong financial plan to help accomplish really what matters most to you. And again, lastly, I do want to stress again that the only way to get market returns is to experience both its ups and downs. There's no special trick or gimmick. It's really that simple. We can't time the market. But research has shown that it turns out we're still human. We have this predisposition to what's called loss aversion, the oldest part of our brain. That's why, again, working with an unemotional third party like an advisor has been shown to boost returns by helping you stay the course and hold your feet to the fire for your own benefit. Vanguard did some great research on this recently and found that the value of advice is worth about 3% in returns, with the largest component of that coming from behavioral management, making sure that clients don't get too greedy when the market is high and not too scared when the market's low, so that you don't make financially fatal mistakes. So thank you all for being here. What other questions do we have that I can help with here today?
So I did have a couple questions. I know we're going to maybe go a couple minutes over, but I figure people, if they're interested, can stay, or if they need to head out, they're welcome to watch this part in the recording.
I was told this is mom. Okay, it's my wife's cup, but this is what I got today. So.
That's okay. That's totally fine. So we had a question about mutual funds. So they said, I've heard that it's more beneficial to invest in mutual funds. Is that true? Talk to us a little bit about that. And you might want to throw in the ETFs.
Yes, yeah. So mutual funds are great. The reason that people like them is because they have a lot of diversification. There are different mutual funds that specify in different things. You can have mutual funds that focus just on US large cap value holdings. You can have ones that invest in Asia, excluding Japan. I mean, there's mutual funds that just go all over the place. But again, mutual funds are fantastic. What those are intrinsically are funds that you have a professional fund manager managing the assets for a specific goal. So knowing what the goal of the investment is, or knowing what the goal of the mutual fund is the first determining point to whether it's a good investment for you specifically or not. Those are what are called actively managed funds. ETF, exchange traded funds, those are passively managed funds, and they just track an index. They're very low cost. Some markets make sense to have active management in. In my opinion, I think that bonds make sense to have active management. I think that mid and small cap US side makes a lot of sense to have active management and a lot of international holdings and commodities. Other areas that make sense to have an ETF, like US growth, could make sense there. But yeah, the benefit of ETFs and mutual funds, to simply put it, is the diversification. Now, you can be diversified in just a handful of underlying companies, or you can kind of have a broad-based mutual fund. The market is just so wide for that. But having a combination is generally the best strategy.
I know there are fees associated with mutual funds, so that might be also a factor in determining. But your financial advisor is usually the one helping you pick those. So
correct. Yeah, they're going to help combine the right funds. In the portfolios that I manage, we use both ETFs and mutual funds. And so where it makes sense to have a low cost ETF index tracker, plug it in there, great. On the flip side, where we think an active manager is earning their keep, we'll implement that. We don't make any mutual funds of our own. And first of all, it'd be too hard to say, Northwestern Mutual Fund. So we kind of are agnostic to products or anything like that. We just try and develop the portfolio that makes sense for the specific investor.
All right. Well, we have time for one more question. And so you talked about those 9 asset classes. Where does real estate and other kind of like other places where you could put your money as investments, like your home or in a small business, where did those fit in?
Yeah. So what I was talking about with those 9 asset classes, that's what we can invest in publicly traded companies, publicly traded assets. Commodity. So the 9, in no particular order, are US large cap, mid cap, small cap, international emerging, international developed, real estate. Real estate would be like a real estate investment trust or a private real estate fund. Commodities would be like precious metals, gold, wheat, oil, that kind of thing. And then the last one would be fixed income bonds. And then the last one after that would be cash. So taking into account somebody's like rental portfolio, I have a number of clients that have rental properties. That's what we kind of treat as the mailbox money, and then the investment portfolio is on top of that. For that kind of client, we might take out real estate from the invested portion because they're already heavy in that, in their private investments. All
right. Well, this is a good one to end on, and we did go a little bit over, but we did receive some thank yous, by the way, for such a great webinar. Lots of information. I'm sure folks were interested if they wanted to watch this again. Yes, we will have a replay link that we will email out to you, so look for that in the next day or so. And of course, we will be posting it on our website, advicechaser.com, and also on our YouTube channel. Thank you so much for attending. On behalf of Advice Chaser, we want to thank Josh for being here and being such a great presenter, and also for the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
See ya.